what is depreciation, and what's the point? So property investor, let's say, goes and buys the property. What is depreciation? Why should they get a depreciation report?
Yeah, look, depreciation is essentially the wear and tear of any goods. And in our sense, depreciation on a building is going to be the wear and tear on building goods, such as brickwork, glazing, flooring, roofing. Any structural element that's part of a building is considered depreciation on Division 43, okay, which is your capital works. That's what we refer to as a technical tax term. Now, on the other end, we do have depreciation of plant and equipment as well. Depreciation of plant and equipment is essentially all your, motorized equipment, such as ovens, range hood, hot water services, tapware. These are also considered depreciable assets under Division 40 with the Tax Assessment Act. So having these two items categorized allows us to go into a property and realize what can we claim and what can't we claim. Of course, certain things we can't claim, such as organic materials, such as landscaping or softscaping, plants and whatnot. But of course, when it comes to anything man-made, essentially, we can claim that. And so as a quantity surveyor, it's important to understand these, and so that we can give clients the best advice when it comes to what they can claim in a rental property or a commercial property, and understanding that is going to be a key.
And so that's what depreciation is. It's obviously loss of value on the structure, like you just talked about. So what's the benefit to that depreciation for the property investor? How do they benefit out of it, like negative gearing and all that sort of stuff?
Yes, so if you've got a property that you're claiming depreciation on, of course, assessing all these plant and equipment as well as building works will give us a depreciable value on the plant and equipment. So, for example, we'll work out, okay, you've got $50,000 or $100,000 on this granny flat. Now, what we're going to do is break down the plant and equipment and also the building works each financial year. So, for example, a piece of plant might cost you $2,000 for example, air conditioning unit. But in the first year, you're going to get $300 as tax deduction. We add it with $300 on the hot water system, et cetera, and the building will get you $1,000. So total in the first year might be $5,000, and that becomes a tax deduction to your personal income.
The question I often get from clients is it worthwhile for me to actually engage in getting someone to do a property depreciation report? So after I go through explaining to them, look, the land value is going up, but in all likelihood, the building value is going down. That's depreciation. You're most likely going to get value out of getting the depreciation report, A, to claim the depreciation itself, and B, the cost of actually getting the report done is deductible in and of itself.
Yep.
So I look at it from all angles. 99 times out of 100, the value proposition is there. Is that your experience where everyone gets value out of getting this service?
Yeah, so essentially, of course, over time, the gist of it is property prices are going up. But when they talk about property prices going up, it essentially means that the land value is appreciating. In every circumstance where you have a building that's on a piece of land, the building value will decline. That building value, what we need to do as a quantity surveyor, engaging a quantity surveyor is critical because that building value is split between plant and equipment and building works. Okay, so that building value is having, of course, what I said to earlier, was encompassing all your plant equipment, range hood, cooktops, oven, air cons, hot water systems. These assets here will depreciate a lot faster than the actual building itself, and they vary. You've got depreciation rates of 10%, perhaps for air conditioning units, and only 5% for something that might be shorter lifespan. So you might have something like an oven, which would depreciate slower compared to carpet, which would require 12 years of depreciation. And getting these assessed is going to be critical. And so where you're going to find the value is getting a depreciation schedule for the component of the building that to work out the decline in value over time. And because that fee is also tax deductible from a quantity surveyor, it's worthwhile to get that done so that way you can also then claim that over a life of 40 years or 25 years, depending on the use of the building. For a commercial space, it's 40 years, but if you use that commercial space for manufacturing goods, or it's a hotel or motel or accommodation for guests, then it's going to be reduced to 25 years. So that's where you can get faster depreciation, given the use of it is going to be a lot more aggressive in wear and tear. So that's something that aids.
And the
you
resi
out.
would be 25 as well?
It's 40 years for residential properties.
40 for resi, okay.
Because it's similar to same as an office space or a warehouse. They're all 40 years. But once you start using them for manufacturing facility or more, accommodation type premises, like a hotel or motel, it definitely allows.
So the logic is the wear and tear would be greater on the commercial use, therefore the shorter life expectancy.
That's
okay,
right.
Yeah, makes sense.
Exactly. Same principles apply to carpet compared to an oven. The wear and tear is going to be greater on an oven because it's motorized. So hence, it's only got a shorter effective life of maybe 5 to 7 years, whereas carpet might be 12 years. Other things you need to also be aware of is, like, for example, you've got tiles in a property. Tiles are considered capital work, so it's going to be a 40-year depreciation. Whereas if you put vinyl or timber flooring or carpet, it's going to be plant equipment and can depreciate over 10 to 12 years. And the reason why is because tiles are essentially stuck on, as opposed to carpet and whatnot.
Cool.
Other
So
fixtures.